Hello everybody, this is Toni Turner and welcome to the market now as of about 1 p.m. Eastern on Friday, May the 12th. Before we start, please know that all of us at ToniTurner.com wish all of you moms out there a very happy Mother's Day. And now on to the market. U.S. stocks have been edging lower so far today and are on track to book declines for the week, weighed down by financial and industrial sectors. Wall Street has been trading in a tight range in the past 2 weeks, with the S&P 500 not moving more than 0.4% in either direction, and the VIX, which is the fear gauge, hovering near 2-decade lows. Retail stocks were under pressure again this morning after JCPenney reported lower than expected comparable store sales, sending its shares down nearly 10%. 8 of the 11 major S&P 500 sectors are lower, led by financials and industrials. And now after that news, let's go on and look at some 3 charts that could give us an insight into the week to come. First of all, as we usually do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our S&P 500 index. Now, when I captured this chart today, it was trading at $238.95, which is about $23.89 on the S&P 500 itself. Now, as we know, during the last almost 3 weeks of trading days, the S&P 500 or the SPY has literally been trading and just as I said a minute ago, in a very, very narrow range. It's kind of like everybody's yawning and taking a nap and waiting to see what will happen next. We know that we had our all-time closing high back here at on March 1st of $240 and change. So far, the S&P has not been able to get back over that line again, that resistance level again. The S&P 500 fell down from this high down just a little below its 50-day moving average and then popped back up to close again above it on March 27th. It fell to a low of $230.61. It then managed to hold that rally back up above the 50-day moving average and then came back down to find support again at April 13th at $232.51. That's right here. So it fell back down below the 50-day moving average and then the 20-day moving average. But then rallied up again. So it made a very shallow double bottom here. That's a good thing. That's a good thing. And then we watched the S&P as it moved back up and into earnings season, into the strong part of earnings season, trading above its 50-day moving average, the green line, and certainly above its 20-day moving average, the red line. So again, it's been trading sideways for the last, I'm going to say, 3 weeks of trading days. If we look down here at the 14-day RSI, we'll see that it is not overbought. It's come up to the 70 line, but then has rolled back down just a little bit, kind of following price action, not telling us much there. The MACD, however, the MACD line, the black line, is coming together with its signal line. We'll have to see if the MACD line itself falls below that signal line, which of course would be a mild positive. The MACD is still above the 0 line, as it would be because the index is above its 50-day moving average. Now, if you look down to the volume spikes with me here, they may be hard for you to see, but you will note, or you'll be able to see here, that volume has not been as strong in this consolidation zone for the last 2 or 3 weeks. It hasn't been as strong as it was back in April. So maybe we also have a few people here saying, oh, heck, it's May. I'm going to leave. I'm going to stay away. But so far, the bears are pushing down and holding price down. The bulls are buying and pushing it up, and so it is consolidating sideways in a very quiet move. I am maintaining my cautious approach right now until the SPY can show me that it has the power to move up here above 240 and begin a new uptrend. Now, to do that, it may have to get more of a running start. It may have to fall down below the 50-day moving average. And it may have to even fall below that down to 235 or even down to 233 or 232 where these lows were before. So there's a ton of support here, potential support I should say, if the SPY falls. Now all we can do is hang out and wait. The market, as they say, is priced to perfection, and I suspect that any little movement that comes along that is really offers some kind of negative, has some kind of negative meaning to it other than anything we've seen lately, may take this market down a little bit, and quite honestly it would give us some better opportunities. So it may not be a bad thing, but for now I am cautious and waiting and watching. Our next chart today is a chart of the IWM. This is a chart, a daily chart of the iShares Russell 2000 ETF. This is the ETF that we watch when we do get a little holding our breath about market direction. And that's what I'm doing right now. I'm kind of holding my breath. I'm not unhappy, but I want to see what happens here with the mood and manner of the Russell 2000 ETF, as many times this can act as a leading indicator for broader market movement. Now, small caps, that means small capitalization. What that generally refers to are companies valued at the $300 million to the $2 billion in that range, $300 million to $2 billion. Those are referred to as small caps. And as I said before many times, this small cap index has the ability to act as a market indicator, so I like to keep track of it during these times. Now, we know that we had a very recent all-time closing high on April 26th at $141.81. Since then, the SPY has lagged the S&P 500 and the QQQs. It has come down to sit atop its 50-day moving average. So now it's sitting right on it, especially the last 2 days. It has fallen down to this line. Now the 50-day moving average had been moving horizontally. In the last few days, it is turning slightly to the downside, very slightly, just a very, very mild negative. We want to see if the if the IWM can stay above this 50-day moving average. That's important. It also has quite a lot of price support here, so that puts two indicators together, price support and moving average support. That puts two indicators together at this $137 line, making it very important. Now, we also have support down here at about 133. That's the support I would really not, I don't want to see broken, because if the IWM moves down below 133, then of course it will head for its 200-day moving average, wherever that is when that time comes. And that, again, could be a broader, it could pressure the broader market lower. So let's keep an eye on the IWM in the coming week. Our final chart is one that I don't think we've looked at in a long, long time. Now this is a little insurance play here. This chart is a daily chart of the VanEck Vectors Gold Miners ETF, symbol GDX. The VanEck Vectors Gold Miners ETF has 52 holdings. The top holdings, the top components are Barrick Gold Corporation, Newmont Mining, Franco-Nevada, Goldcorp, Agnico Eagle, and Randgold. Now, if the market does pull back in the next week or so, it's always a good idea to have an idea where you want to go or have access to a safety net. Now, right now, I'm watching the gold miners ETF as sort of a safety net here, somewhere to go if the market does pull back. Now this is a little different trade than we are used to, granted. What we consider this trade to be if the market falls is a hedge against a falling market, or a safety net. Now that may lessen the holding time that we hold the GDX, if in fact we even get into it at all. But it's always a good idea to have kind of an exit the market or get into something new if by any chance this market decides to pull back to any degree. Now right now, when I captured this chart, the GDX was trading at $22.78. Now in August of 2016, and you can't see it on this chart, it was trading at a high back then at $31.79. After that, it fell down to this low here in December of $18.58. Then it started to rally from there, from this low, built a little tiny base here, but rallied right up, moved up over its 50-day moving average, up over its 20-day moving average, the red line, moved up over those, back up to resistance here of about 25, and that's prior resistance if that were a straight line, then fell back down. Gold doesn't trade like a lot of stocks. It trades a little differently, and these are gold miners, which is a little more orderly than gold itself many times. Then the GDX fell back down to support here at about $21, rallied up again, and recently fell back down to $21. So now we have an indication here that there are buyers or potential supporters at the $21 line for the GDX. Now in the last week, as traders are starting to get a little antsy about the market, the GDX has started to rise. You can see it rose above today. It's falling 20-day moving average, and right now as I captured this chart, was sitting just atop its 50-day moving average. Now, if the market rallies next week, the GDX could pull back to support here. That's possible. But if the market drops, the GDX may continue higher. And of course, both those things could happen. It could fall back a little and then move higher. If I go long the GDX, if the market does pull back and I go long the GDX, my initial absolutely no kidding around stop will be down here at $20.70, which, let me put a better line for you, which would be right around there. Because if it falls below $20.70, then the short sellers could come in and pound it even lower. So I have a very definitive stop here, an initial stop, a no kidding around stop at $20.70. And if I do get in and the GDX moves higher, I of course will put a trailing stop on this particular position. And of course, if it moves above the 50-day moving average, that will eventually become my stop. Strategies such as these are what we use in Toni's Market Club when the market gets a little dicey. We have one or two other plays we're also looking at right now, similar to gold. And it's just you want to know what to do if the market starts falling. And again, these are the kinds of plays we make in Toni's Market Club when the going gets rough. Otherwise, of course, we are in stocks and exchange traded funds that are hopefully moving higher, and most of the time they are. So let's go on now to this week's economic report. But first, let's talk about Toni's Market Club for just a moment. We'd like to have you join us this coming Monday, May 15th. We will talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. And of course, if the market does move down, we will have strategies to use that will help deflect that move. Toni's Market Club is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who cannot attend our live session, there is not a problem. The recording of our session is available just a few minutes after the session ends. For more information and to join, go to tonysmarketclub.com. And now for the economic reports. On Monday, we have Empire Manufacturing. Tuesday, we have building permits and housing starts. Wednesday, we have our usual weekly crude inventories. Thursday, we have our usual jobless claims, the Philly Fed, and natural gas inventories. On Friday, not any economic reports of any note going on. Again, please join us for Tony's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading skills and your trading profits. Until next week, happy Mother's Day. Keep green on your screen. I'm Toni Turner, and this is The Market Now.